This trading strategy is so simple that you will question yourself on why have you made trading look so hard and complicated before. So let's take a seat and learn to get simple trading setups similar to this one. Alright, let's begin. The strategy we are going to talk about is the break and retest, but with the implementation of price action, market structure, and the usual smart money concepts. So to understand this trading model, we need to first understand basic support and resistance. When we see a resistance being formed at the top here, and then a support being formed on the bottom here, this simply means that buyers are holding the market to the upside every single time it comes down here, and sellers are holding the market to the downside every single time it comes up to this level. So basically in this area, sellers are more in control than buyers, and in this area, buyers are more in control than sellers. We need to understand the fundamentals of basic price action to understand why any strategy can work. And the basic fundamentals of any movement in essentially any tradable market comes from one thing, from buyers and sellers. So if we begin to understand where the buyers and sellers are holding their positions, we can simply plan a strategy that utilizes buyers and sellers to help us achieve the highest win rate we can get. Now let's say that the resistance broke out to the upside. Does that mean that we should enter the market for a breakout trade to the upside? Not necessarily. If we apply the plain and simple break and retest trading strategy, we want to wait for a pullback into the broken resistance, which also means that a resistance that has been broken to the upside flips into a support. So following the simple break and retest plan, we would look for buy-long setups on the newly formed support to basically take the market into new highs. But this simple strategy has some flaws. We don't have a mechanical step-by-step plan for the entry itself, meaning that the entry can be kind of random without making any sense. Another flaw of this strategy is that the breakout can also be a trap to take liquidity from traders and push the price towards the opposite direction. And another flaw of this strategy is that we might be buying at an already high price when there could be better opportunities. Similarly works if the market breaks down the support. That means sellers taking over and gaining control over the market. So if we apply the basic break and retest strategy, the recently broken support flips into a resistance. And when the price pulls back into the resistance, traders are looking to open sell short positions. But in this situation, the same flaws apply. We don't know where to enter, on what candle. There is no specificity. And the breakdown could have also been a liquidity trap, just to take the price into the opposite direction. So the way to remove those flaws and create a still very simple and effective trading strategy is to implement more detailed price action concepts, market structure, and some concepts used in smart money trading. So let's see how that would work. The first method is to carefully watch what was the macro trend that the market was running before the formation of the consolidation. So as an example, if the initial trend was following an uptrend with swing higher highs and swing higher lows, then the market started to consolidate. We don't need to try to predict if the breakout will happen to the upside by breaking the resistance, or if the breakout will happen to the downside breaking the support. We just wait for the market to first break out of range. And here it comes, the application of the high time frame priority. If the initial trend was following an uptrend, the market has higher probability of the breakout happening to the upside. Basically, we are trading with the trend. Now, as I said, we don't actually try to predict that by instantly buying long near this trading range. We first want to wait for the breakout. So now after the breakout, what should we look for? Well, as we know, the resistance flips into a support, but what we actually want to do is analyzing if there is a bullish liquidity structure in form of an entry model near the newly formed support. This can come in form of a demand or in form of a bullish fair value gap. And we look to buy long near those areas with a stop loss below that entry structure and take profit above the recent highs, or it can be lower if the risk to reward ratio is great. And if there isn't one of those structure visible near the support, we have two options. We can zoom into a lower time frame to look there for a setup, or we can just give it up and look for another opportunity. And if the market initially followed a downtrend with lower lows and lower highs, then the market starts to consolidate. And because the initial trend was bearish, the most probable scenario is that the market will break down the support and flip it into a resistance. Resistance where instead of just blindly sell shorting, we look for liquidity and structures that helps us to refine the entry setup. Those structures can be a supply zone or a bearish fair value gap. So these are the two common ways this trading plan can be done. Now we need to know that the market will not always respect our plan. We can meet scenarios in which the initial trend is bullish, and the consolidation actually breaks to the downside, basically reversing the trend into a downtrend, just like we can meet an initial downtrend, and the consolidation actually breaks to the upside, now reversing the trend into an uptrend. So wrong things can happen, and it's important to know that. However, that's completely fine, as long as we control the risk to reward ratio. With just a 1 to 2 or 1 to 3 risk to reward, we only need few wins to cover many losses. So the first example on a real chart, initially we see that this market was moving straight up. So basically a very clear and easy to observe uptrend. Then the market begins to move kind of sideways. It's clearly moving different compared to the type of movement we've had initially. Then the market goes straight up again, breaking above the highs finally with increased momentum and a clear intention to drive the market up, which is then followed by a small pullback. So if we pay attention, this is exactly the type of pattern we've talked about earlier. We got the resistance right up, with the price rejecting the resistance and moving away from it, and we got the support right below here. With the market rejecting to the upside many times, it has hit this zone. Now we can also see that the support was trying to get broken down, but it failed to do so. This is not a break. This is more of a liquidity sweep because of how many wicks were present. An actual breakout happens with closure of candles below the zone, with a couple next candles also showing an interest below the zone, but here that did not happen. But here that actually happened was to the upside, basically by breaking out of the resistance, and this is a much cleaner and high-quality breakout. The price also is right now situated right at the resistance after the breakout. Now, as we said, the broken resistance flips into a support. And coupled with the fact that the market initially was in an uptrend, the higher probability move would be continue the trend. And because we are looking to trade with the trend instead of trading against it, we look towards buy-long opportunities. But before that, we can also zoom into a lower time frame to refine the setup even more. This is the 1-minute time frame. If we do a quick market analysis on market structure, this is a simple uptrend. Here we got a bullish break of structure, formed from the pullback after it has created the local high, then the continuation of the low time frame uptrend by breaking the previous local high, which holds this upwards push for quite some time. Then after marking another local high, we got another downwards pullback, which is then followed again by an upwards push to the upside. So again a formation of a bullish break of structure. Now after the last breakout in the lower time frame internal structure, the market formed a small consolidation. That consolidation was first broken down to the downside, then shortly after the market gains massive momentum and breaks towards new local highs and swing highs. Now why it did the first wick to the upside like that? As I said earlier, quick wick like these just to reverse the move after. Most of the times the initial move was a fake out or a liquidity sweep. So let's analyze why it happened there. And if you understand entry models well, you probably observed an internal demand zone that corresponds to the previous price action formation, of course internally. Because remember, on price action structures like these ones, we got an initial trend, which in this case is a bullish one, and the market pulls back and then breaks the highs, forming a bullish break of structure. Well, this breakout validates a demand zone on the swing lows, a demand where we can enter to take the market into new highs to essentially ride the trend. And coming back into the chart and applying this model, we can place the buy-long entry on the internal demand. The stop loss coincides being below the demand, and as well as being right below the newly formed support, that was a resistance before breaking out, and the take profit is usually placed above the swing highs. So now it broke above the highs and closed the position with a take profit. By breaking the highs, we external bullish breaks of structure, similar to the ones from before. So basically we can do the same type of trade if the market allows it. But for that we need more visibility of the upcoming price action. This might be enough. So the market continued to form the breaks of structure, and also did not manage to break the past swing lows, making these lows as protected lows or strong lows as they are also named. And now the same price action structure repeats. So we got a demand zone near the swing lows, with the market moving into the demand. So that brings us another buy-long opportunity, with the same logic and similar setup positioning. Now pay attention to what the price action has formed. We've got the price forming higher lows, and higher highs. So far we're saved, and the setup looks good as long as this trend holds up. And looks like it has held up, basically done the same action of breaking highs following the uptrend. And we can basically do a similar setup again. This changes if the market starts a bearish internal trend that slowly moves towards the protected lows, which they break downwards. Then we can talk about looking for sell-short setups. So let's test another similar example that I've seen on the charts. Here, just like the previous backtest, the initial trend was bullish. Then it formed the consolidation that moves the market sideways for a while, just to push it upwards to break the resistance. With clear candle closure above it, the market then retests the resistance and bounces up directly by a huge bullish candle. These type of large candles most of the time leave an imbalance. And if you know how to identify and trade imbalances, this won't be hard for you. There is the inefficiency that left a price gap on the chart. Inefficiency that we know should get filled at some point where we open the buy long order, taking the market into new highs. And this was done at near instantly, by again printing another large bullish candle, so probably the same kind of setup can be run again. Into another one, so we make sure everyone understands it well. This one is on the AMD stock. This strategy works well in all markets. Right here, we see that we finally got an initial downtrend, with clear swing lower lows and swing lower highs. So moving into the most recent price action, we see a consolidation being formed after the trend has been initially a downtrend. So we draw the resistance, and we draw the support, and we check the upcoming price action. So looks like the market rejected once again from the resistance, and then it moves aggressively towards the support, which eventually broke it down. Shortly after, on the upcoming candles, the price slowly moves towards the support that has now flipped into a resistance. Now we simply just sell short the resistance. But the problem by taking this simple approach is that we don't have a clear entry structure, and it's mostly subjective entries. They can work, as I said earlier, but they're more of a dangerous approach. To refine the setup, we can switch to a lower time frame, and we can find an entry structure there that in case if we can't find one on the main time frame. So right here we've zoomed into the 1 minute time frame. If we closely analyze liquidity, we should see on the first site how the market took liquidity orders from an ascending trend line. And what we actually look for is an entry structure. One of them can be a supply. Of course, on downtrends we look for supply zones. And we see that this setup has worked out well, but let's also see if the initial setup would have also worked. And yes, it did close on take profit. Also pay attention to the market structure that has been formed. Look at each of these swing highs. So we got simple lower highs. And look at the swing lows, they're lower lows. And the market just followed that price action until it has finally moved into the take profit. Keep in mind to pay attention to market structure, because usually we look to trade with the trend instead of trading against. Now we also have to talk about what to avoid on these types of setups. So look at this chart, starting from the left. The market started a consolidation, moving towards the resistance and rejecting away from it towards the support. And this action kept happening for some time, but then the breakout finally happened. It first happened to the downside, essentially breaking down the support. So usually we would look for an entry structure to sell short on the newly flipped resistance. However, the market pushed upwards significantly, right after breaking down. And finally, it has managed to break the past resistance, but then failed to hold above. So what happened is a sell-off towards the lows once again, breaking down below the flipped support resistance, and then a similar price action happened. So this, a choppy consolidation with many liquidation for both buyers and sellers. So why does this happen? Well, usually this choppy market forms when there is a lack of liquidity on the market. So to feed liquidity into the market, it looks to pull out random and unpredictable moves towards both sides so it can gather enough liquidity to move into a trending market. And the way to avoid this is simply to look at the candle formation and candle sizes. The price action inside the trading range does not necessarily need large-sized candles. However, the breakout should have larger candles towards our trading side. In our preferred case would be an aggressive bearish candle and not a bullish one. A large candle indicates an increase in trading volume. This increase in volume shows that there is interest in moving the market. If there is not enough liquidity or volume, the market simply won't respect our trading plan. So key note to remember, the breakout should have larger candles towards the trend we have planned the setup for. Another warning you have to be careful of when using this trading strategy is to be aware of high-impact news. For example, in this chart we see the initial trend was bullish, and the market formed the consolidation. So far, nothing out of the ordinary. The market moves in between the resistance and support, just like we would expect. But then, the breakout happens near instantly, and it doesn't even pull back to retest the newly flipped resistance to give traders a setup opportunity. Instead, it just moves straight down. This large move was caused by high-impact news. News don't impact swing trades that much because the move isn't that large on high time frames. However, on scalp trades or intraday positions, we should look to avoid having open positions or orders when there are high-impact news. So now let's jump into a final backtest. By now you should be able to follow the strategy step by step without any big problems. This market that we see on the chart, we can see it follows a clear downtrend, externally forming swing lower lows and swing lower highs. This market structure keeps printing for a while, until the market finally slows down into a consolidation phase. Also pay attention here. If you're a viewer of my channel, or if you master smart money trading, those traders probably got a clean trade before the consolidation. Look here at this bearish fair value gap. After the market formed the local lows, the price went right into the fair value gap to rebalance the market. This type of setup I show on my channel quite frequently. A bearish fair value gap setup is taken with a sell short on the hit of the imbalance, with the stop loss above the top of the imbalance, and the take profit usually below the swing lows. Or it can be higher if the risk to reward ratio is good enough there. And this setup closed as a win shortly after. But this was just a quick observation. So now let's go back into analysis. We see the consolidation being formed, so we got the resistance right up here. And we also got our support down here. On the most recent price action we're able to see right now, the market has hit and rejected the resistance once again. So let's play the price. Looks like the resistance broke down. That flips the resistance into a support, and the price right now is retesting it. There are also two large bearish candles. These type of large candles often leave an imbalance. So to check if there is one, we can zoom into a lower time frame, from the 15-minute into the 5 minutes, so just one time frame lower. Look at this gap on the chart. These are price levels empty of liquidity that should get filled at some point, and we apply the theory of fair value gaps. The fair value gap being situated inside this trading range between these lines. Similarly to the previous bearish fair value gap, we look to sell short the first hit of the gap, with stop loss above the top of the gap, and take profit below the lows. We can go even lower to get a better risk to reward, but not too much. And here it looks like we are entering the position. The volume started kicking in, and it moves into take profit soon after. So as a final recap, we have two scenarios. If the market initially starts off as being bullish, basically following an uptrend, we wait patiently for the market to form a consolidation. After the consolidation has been formed, we do not try to predict where the breakout will happen, but instead we wait for the breakout to actually happen first. Because of the initial trend being in an uptrend, the market has a higher probability that the price will break the resistance up. In that case, the resistance gets broken, and it flips into a support. Then we wait for the retest back into the support. That is the moment where we will look for entry structures like fair value gaps and demand zones. Structures from where we look to buy long, taking the market into new highs. But what if the market breaks down the support, while initially being in an uptrend? Well, I would skip this trade and wait for another opportunity to trade. There is also the opportunity to look for sell-short entry structures on the retest. But in this scenario, you are trying to predict a high time frame reversal of the trend. And as I said earlier in the video, this strategy is based on following the trend and not about trading against it. And if the market initially is bearish, we wait for the consolidation to form. Because the initial trend was a downtrend, the more probable scenario is that the market will break down the support, which flips the support into a resistance. And we wait for the market to retest the new support. Moment where we will look for an entry structure to take market into new lows. There is also the scenario where the market initially followed a downtrend, but it broke the resistance towards the upside. In this case, I would not trade this setup, because as I said before, this means that you are trading a potential reversal. And this strategy is mostly about following the high time frame trend. If you're looking for extra resources, you can check the link in the description as I train traders in mostly getting funded. If you liked the video, leave a like and subscribe, and thank you for watching.